Hello. The April investor overview will focus on the economic impact of the Russian-Ukrainian conflict. While I share the hope of many of you that the conflict will come to an end as soon as possible, its economic impact will remain with us for some time after the peace agreement. Let's look at the effects of the current war, and as these mostly affect investment, we will also look at what you yourself can pay attention to. Russia is in the global economic bloodstream primarily in the area of raw materials, and that is where the impact of austerity will be felt most. At the beginning of the list is the category of industrial metals. 20% of the steel used in the European Union is imported, almost half of which comes from Russia. Its stop means that almost 10% of the total will have to be replaced from elsewhere. That is why you can choose from the companies in the steel industry that can give you a good result. The same is true for aluminium. Aluminium production requires a lot of electricity. And in many cases it is still produced in hydrocarbon-fired power plants. That is why the high cost of electricity has led many aluminium companies to stop production. The shortfall cannot now be made up by Russian imports. Those that have survived are demanding higher prices for their product, and this is reflected in their results. Let's continue with food. Normally in March and April, agricultural work is already well underway in the fields. Ukraine is the European Union's fourth largest food supplier so far. Although farmers are probably still producing, there is likely to be a drop in yields. And you can see this expectation in the price of wheat. Although Hungary is not directly affected, but it will be more affected indirectly. If you think about the fact that food prices will be higher in the Union because of the war, this will be reflected in the wage demands of workers over time, and will also be reflected in the price of products there. We can only import these products at higher prices. This will be an inflationary factor everywhere. As an investor, the best way to prepare for this is to invest in assets with a yield above inflation, as you are less likely to buy and store wheat at your home. You could say that if Ukraine is out, we'll grow it ourselves. That could work, but it also requires fertilizer, which is based on natural gas. Fertilizer production was already hard before the war because of high gas prices, but with the loss of cheap Russian gas, we've got to the point where it's built into the price. If you think in fertilizer manufacturing companies, they have also experienced dynamic growth since the beginning of the year, and since agriculture uses nutrient supplements not only in the spring, but also throughout the year, we can expect demand for their services to remain. Speaking of natural gas, we have now come to one of the most cardinal points, which is oil. You yourself are probably aware that the price of oil has risen significantly since the outbreak of the war. How this will continue to change depends, of course, on the outcome of the war. But there are several reasons for the high prices. On the one hand, the sanctions against Russia have reduced the use of Russian oil. Although there is a strong demand for independence from Russian exposure, this will take time. In the best-case scenario, it will take 1 year to bring enough wells on stream to meet this demand. That is why oil and gas companies have already made good results since the beginning of the year, and are expected to continue to do so as long as the war continues. Let's look at what the result will be if we stay with high oil prices. The answer also depends on how long it will be with us, when it will settle down. No ultra-short-term solution is expected here, so we will face some impact. In the short term, both private individuals and businesses may choose simply not to use their cars, because they will stay in their home offices, or if it is necessary, use them more optimally. In the case of companies that are also involved in production, they will either incorporate the higher prices into their prices or stop production after a while. Both options point in the direction of an inflationary pressure. If this high exchange rate continues in the long term, or even continues to rise at the same dynamic, there is a risk that this one factor will cause a recession. The graph shows the price of oil per barrel in blue, and the gray bars indicate a recession. Here it is not just oil cries, but a recession of any cause. You can see that where the price of oil has risen very sharply and the economy has not been able to keep up, a recession has followed. It is legitimate to ask whether we can expect the same situation now. The very short answer is that no one knows in advance, because it depends on a number of factors. If you just look at current prices, anyone can see that fact in reality. They have risen suddenly, and you are seeing the highest prices in recent history right now. This is even more powerful when you consider that during the first wave of COVID the exchange rate was negative. But if you look a little bit further out and you look at the period after the 2008 crisis, you can see that arithmetically you still had to pay the same price for a barrel of oil. But if you take into account the inflation since 2014, the amount paid then was roughly equivalent to around $220 at today's exchange rate. And yet there was no recession, so whether there will be a recession will of course also depend on whether the economy can absorb the impact of this rise. Now that we've run through the effects of the war, let's look a little bit further out. To summarize what we have seen so far, the winners in equities so far in the war have been oil and gas, fertilizer and commodities companies, and we expect them to continue their gains. However, the confidence that investors had shown after the outbreak of the COVID has disappeared. The market is volatile and you really have to think carefully about which investments to say yes or no to. You can contact a licensed colleague via the link in the description. Contact us to see how you can best get ahead in the current economic situation. Because the economy is changing. In response to high inflationary pressures, central banks globally have started to raise interest rates, but this was not a move for its own sake. With that step, a lot of things have been reoriented. Both individuals and firms are facing higher lending rates at banks. This is making them think twice about whether they want to invest or develop now. This appears in large numbers, for example, for cars and real estate. Cars, as a high-value asset, are often bought on credit. Although the previous shortage of chips had pushed up prices, the large economic stimulus packages have made buyers less price-sensitive. This has been seen not only in stock market indices but also at the rates of car manufacturers. Now that the money spigots have been closed and financing is becoming more expensive, demand for new cars is expected to fall significantly and in the longer term. And the market is pricing this in. The housing market may be in a similar situation, but with a much longer reaction time. Although the price of building materials has risen significantly in the past, this has mostly affected the price of new build properties. Fortunately, brand new houses only account for a small proportion of the total market. Whether we are talking about new or used property, sales are made more difficult if the buyers are no longer approved for a loan by the bank under the new conditions, or if the buyers say no themselves, saying that this is too much for them. Typically, the story can then take two directions, and the foreshadowing of this is already beginning to be felt. One is that the current prices will remain, but for the reasons already mentioned, fewer deals will be done, so there will be fewer transactions. The other direction is that the number of transactions will remain, but prices will moderate, which could not be seen event in real estate for a long time.